Hey guys, this channel is all things related to personal finance. So today I want to dig into a topic that's really relevant to you if you've thought of investing in real estate, or maybe you have invested in real estate in the past. A very common question when considering a property purchase is how long that mortgage should be. Is it better to do a 15-year mortgage or a 30-year mortgage? I often find myself wondering which is better, a longer time frame to pay down a mortgage or a shorter one. I mean, both of them have their pros and cons. So let's take a look to see which one is better. Without a doubt, one of the big benefits of a shorter mortgage is that you can squash that debt obligation much faster. Having no debt on a property just gives you major peace of mind, especially if you're maybe a bit older and you don't want to have this big financial commitment or obligation on you even as you start going into retirement. And of course, once you've paid off that mortgage, if you're living in that property, then all of a sudden your living expenses will drop significantly, which is great, right? And maybe you're not living in that property and instead you're just renting it out. Well, once that mortgage is paid off, all of a sudden your cash flows from that property is going to jump up because your biggest monthly cash outflow, your mortgage, is now no longer there because you've paid it off. When it comes to interest rates, the higher the risk the bank considers you to be, the higher the interest rate will be that they charge you on that mortgage. It's basically the bank being compensated with a higher interest rate for being able to extend you a loan if you're considered a higher risk client. Now, there's many factors that impact that interest rate, like your salary, your credit score, how big the down payment or deposit is that you give for that purchase, and how long the mortgage time frame is. So why does a shorter mortgage mean lower risk, you may wonder? Well, the longer the bank has money payable from you to them, the higher the risk will be to them. There's just so much more uncertainty with a longer time frame. You know, maybe you lose your job, or maybe you start a business and it doesn't work out and you lose everything. Or maybe some family need financial support, which of course puts some additional financial pressure on you. Life happens, you know. So the shorter the time frame, the lower the risk to the bank that something unexpected may happen. And because of that lower risk, the bank will be more willing to reduce the interest rate that they charge you on your mortgage. Now, I mentioned earlier that your salary can also affect your mortgage application. So most banks will apply a maximum threshold that your monthly mortgage payment cannot exceed as a percentage of your total net salary. For example, here in Italy, your monthly mortgage payment cannot exceed more than 35% of your net salary. And so a shorter time frame on a mortgage will push up your monthly mortgage payments, and that may result in you exceeding that 35% limit, and you may be forced to go for a longer mortgage timeline. In South Africa, I believe that they apply 30% of your gross salary, so this really depends from country to country. So let's put this all together. You've got a shorter time frame of a mortgage and you have a lower interest rate. The combination of these two results in a lot of saving in total interest cost over the period of that mortgage. And let's look at a practical example to show you what I mean. So let's assume you go out and you buy a property for $150,000 and you give a 20% down payment or deposit. So that's $30,000. And that means that you go out and get a mortgage for the remaining $120,000. So let's assume that you do a 15-year mortgage and the bank gives you an interest rate of 2.5%. In this example, your monthly mortgage payment will be $798. And over the full 15-year period, you would have paid $143,727. And that means that the interest component is $23,727. Now we compare that to a scenario where you opted for a 30-year mortgage instead of a 15-year mortgage. Now remember, because the time frame is longer, the bank will consider it slightly higher risk, and so maybe they give you a 3% interest rate instead of a 2.5% interest rate. And so here your monthly payments will be $505. And over the full 30-year period, you would have paid back to the bank $182,813. And that means that the total interest amount that you've paid back on your mortgage over 30 years is $62,183. So by comparing these two examples, you can see that the 15-year mortgage, you pay way less interest compared to the 30-year mortgage. Now you would have noticed in this example that in the shorter 15-year period, your monthly mortgage payments are significantly higher. And some people may even consider this to be a positive. Because looking at the 30-year mortgage with the lower monthly repayments, maybe you'd be saying, well, I can take that extra amount of money and go and invest it in something else. But this requires a bit of discipline, and maybe you'd be tempted to spend that money on something else and not end up saving it. Whereas with a 15-year mortgage, that temptation doesn't exist because you're obliged, you have an obligation to pay a higher monthly mortgage payment either way. Okay, so now we take a look at a 30-year mortgage. And if you're enjoying this video, make sure you hit the like button. Now we saw earlier in the example that a 30-year mortgage has much lower monthly repayments compared to a 15-year mortgage. In that case, it was $505 compared to $798 a month. And this could be a big plus for you because you could use that extra cash every month to recover your cash reserves from the big down payment and deposit that you've just paid, or to help cover your living expenses, or to take that little bit of extra money every month and invest it in something else to generate additional returns. But as I mentioned earlier, this may require a bit of discipline on your side. So here is the important point to consider. As long as the extra amount of money that you invest generates a return that's greater than the interest rate on your mortgage, then it's worth it. Let's say your mortgage interest rate is 3%, but you can take that extra money and go invest it in, say, a stock market ETF that's going to generate 8 or 9%. Well, then it's probably worth investing in that, generating 8 or 9% as opposed to paying off your mortgage faster and saving the 3%. And if this property is an investment property, well, with a 30-year mortgage, your cash flows are better because your biggest monthly cash outflow, your mortgage, is lower, and that's positive for your cash flows right from the start of that investment. Now, earlier we saw that over the full duration of that mortgage, of a 30-year mortgage, you'll be paying way more interest compared to a 15-year mortgage. There may be a small mini bonus hidden in there, and that's tax deduction. The interest on your mortgage in both examples is tax deductible. So if you have a higher interest cost, it means that you'll be able to deduct more in your tax returns. So which one is better? Well, it kind of depends on your situation. Some countries tend to offer a default timeline when it comes to mortgages. For example, in the US, you commonly see a 30-year mortgage, but I mainly see 20 years in Europe and in South Africa. What about your country? What are the mortgage timelines that you're considering? Let me know in the comments section down below. I also mentioned earlier that as long as you can generate a higher return, then it's worth investing as opposed to paying your mortgage off faster. But this is not always so easy because some countries have higher interest rates. If you had to guess the interest rate that I got on my first mortgage, you won't believe it. It was 14.25%. I know, ouch, 14.25% interest rate. So in that case, it's really better to just try and pay down that mortgage as fast as possible, because generating a guaranteed return of 14.25% is quite difficult. So it's better to just try and squash that mortgage. So you need to see what makes sense to you. But for most people, I think the longer mortgage is a better option because it gives you more flexibility and you're able to recover your cash reserves and also to reinvest any extra funds. Remember, with a 30-year mortgage, you can still pay down your mortgage faster if you want to, and usually without a penalty. So this gives you the choice, but not the obligation, to pay down that mortgage faster and enjoy some of the benefits of a shorter mortgage that I mentioned earlier. Yes, it requires a bit of discipline, but if you're watching this video, you're already informing yourself of the different things to consider and probably aware that you would need a bit of discipline. And of course, you can make this easy for yourself. You can just automate that extra monthly cash flow that you have from a longer mortgage into an investment like an ETF. So which do you think is better, a 15-year or a 30-year mortgage? I'd love to hear, so let me know in the comment section down below. I hope this video was helpful, and if it was, make sure you subscribe to the channel. You can also follow me on Instagram, and here is my handle. I'll see you next week.